Hello and welcome to the Wealth of Advice Market Update on the 26th of February. Thanks for continuing to listen. We're now a full year down the line from when the stock market started to collapse last year when coronavirus became the biggest news story in a long time. Thankfully, a year on, we're starting to see the green shoots of what may come next, the recovery, if you like. We're getting the vaccine rolled out to more and more people in this country. Other countries around the world are starting to get their act together. Obviously, it's dependent on receiving supplies of the vaccine and being able to get it into people's arms. But certainly the news that we're seeing now is very positive. That said, this last week that's passed, we have seen a lot of market volatility. And if you check the value of stock markets every day, you'll notice that there was more red days than green days this week. And just yesterday, I think the FTSE 100 was down over 2% in one day. So clearly, we're not out of the worst of it yet from a point of view of market risk and market volatility. So over the last 100 years or more, the times when world debt has become a real problem, as you can see from this graph, was World War I and World War II. At the end of World War II, the total debt of all developed markets was around about 125% of what their GDP was. So their total output of their country, debt was 25% higher. After the Second World War, as you can see, that purple line fell dramatically, getting back to what was regarded as sustainable levels, so the 60s, 70s. And then from the 1980s onwards, you can see a worrying trend that global government debt to GDP has actually increased. We then had the financial crisis in 2008, where it spiked right the way up. From 2010 to 2020, all world governments embarked on austerity measures. So you can see, whilst they weren't dramatically decreasing debt as a percentage of GDP, they certainly got a lid on it and it stopped rising. And then COVID comes along in 2020 and bang, it's back above the level that it was at the end of World War II. So when people say that this has been a wartime-like crisis, from a financial point of view, yes, and a little bit more, because we're not out of it yet. We don't know what the total bill of this is actually going to be. So next week, we have a Chancellor going to stand up in Parliament on Wednesday to deliver a budget. There's lots of speculation in the press as to what he's going to do right now. Clearly, one of the things he will need to do is stop this figure in our country from rising, but he needs to do it in such a way that the economy can still grow as well. He wants people to be spending. He wants everyone to get out and try and help the economy re-emerge. So it's definitely going to be an interesting budget to watch. The next chart that you can see here looks at the unemployment rate, and this is going from January 2019 up to last month, January 2021. Obviously, everything went nuts February, March of last year. Unemployment rate shot right the way up, 15% unemployment for this country, which is just massively high compared to long-term averages and trends. And since then, obviously, the furlough scheme has worked well, but companies have generally been trying to re-employ people where possible, and we're now down to a level just above 6%. Again, talking about the budget that's going to happen next week, the Chancellor will obviously be wanting to get this figure right the way down to the figure around about 4%, which was the long-term trend where they thought it was a healthy position to be in overall. So as mentioned there, we have a budget coming up on Wednesday. It'll be on at 12:30. I'm sure you'll be able to watch it on BBC News or Sky News. The full budget will be presented. In previous years, most people would never really watch the entire budget, just waiting for the snippets that come out at the end when you see them summarised later on in the day. However, this year's budget is perhaps more eagerly anticipated than any in a lifetime, really. More and more clients are asking me during their annual reviews, what do I think is going to come out of the budget? Do I think that we're going to be taxed more in order for the government to pay back its debts? Right now, I can't see why Rishi Sunak would choose to do that. It would be politically damaging for him. And when the government wants us all to emerge from lockdown and get out and be spending money, I don't think it would make sense to tax the individual end consumer, the individual retired person, the man on the street, that much at this stage. That may come later on through this Parliament. However, right now, as I said, they want everyone to be feeling confident and going out and start to spend money. Obvious taxes that they might come at. Corporation tax has already been mentioned quite heavily. So as a business owner, we have a limited company. Our corporation tax rate is 19%. There's talk that over the remaining term of this Parliament, that will go up to, say, 25%. Our corporation tax rates across the world are lower than most other developed markets. 25% is apparently a standard corporation tax rate the world over. So you expect to see that rise gradually over the next few years. But as for income tax increases, I just can't see why he would do that at this stage, but never say never. So we'll be keeping a close eye on that, and be rest assured that if anything comes out with the budget which will affect any of our clients in any way, shape or form, we will be in touch. Some clients have said, well, do we need to do anything beforehand? What happens if he says something on Wednesday? Will that affect me instantly? Most things in a budget that happen that night are typically when he says he's going to increase the price of a pint of beer, or cigarette scope in price, or petrol duty goes up. That can happen that night, whereas anything else that will affect income tax, capital gains tax, inheritance tax, that needs to be ratified by Parliament through a Finance Act, and that doesn't happen on Wednesday the 3rd of March. That'll be some weeks down the line. So if there was any major changes that were about to happen which would affect anyone, then we've got sort of 3 or 4 weeks to deal with it and respond to it accordingly. But right now, everything that we're reading is, from your point of view, there shouldn't be anything really to be worried about. What you should be looking for is the giveaways, in the sense that we were talking about the different schemes that might come up to encourage people to get out spending again. So at the beginning of this presentation, we showed how world markets have performed over the last 2 months since the beginning of January. The next graph shows the various UK stock markets and how they've performed over the last 12 months. The green bar at the top is the FTSE AIM stocks, which is the very, very small micro stocks in effect, stocks that are too small to go on the FTSE 100 or the FTSE All Share, maybe new start companies. That's grew by a staggering 26% over the last 12 months. They would be by far the highest risk stocks you can put your money into, and the ones which were negatively affected with an unknown certainty around what was going to happen with Brexit. And as you can see, from October going into November, when we thought there was going to be a Brexit deal, the vaccine got announced, the smaller companies have performed very, very well. The FTSE 250, the next size category of companies up there, is up 4.3% over the 12 months. The FTSE All Share, which is every share on the FTSE 100, FTSE 250, the entire stock market in it, where that's gone sideways over 12 months, whereas the FTSE 100 is now minus 2% over the last 12 months on this graph. Several times over the last 12 months, we've talked about the Volatility Index, which is a measure of risk that exists in the market. As you can see from the spike at February into March of 2020, it went to unknown proportions compared to previous years. It just really shot off the scale. From March onwards through to June, risk dropped all the way back down, and that was the time when you saw your portfolio start to recover. And then as the year ended, the last 6 months of 2020, there was definite spikes in what the risk feeling, or the risk, this is all about what the markets believe risk to feel like. We got into the new year, we had a risk spike again, and then look in the last week, it's starting to rise again with this fear of inflation returning. So again, just to reiterate, we have had a very good year. There's been very good performance on client portfolios. Every client that we have who was invested through the crisis, February and March of last year, is now back in more than a profitable position. We're having good meetings with clients and showing good levels of growth. But again, just to be aware, risk looks like it's rising as inflation is the big worry for central banks right now. The pound over the last 4 years has had a bit of a good kicking against most currencies. Once we voted to leave the European Union on the 22nd of June 2016, when the pound fell off a cliff, which you can see right at the very left-hand side of this graph, the pound dropped quite dramatically. It then continued to fall during 2017, having some signs of recovery, but then falling back. As we got into 2020, COVID hit and the pound fell against all major currencies, especially the dollar. The pound falling against the dollar symbolised there that the dollar was the safe haven for where money should go to during the times of crisis. Then as 2020 unfolded and we got our Brexit deal sorted, the vaccine was announced, the pound started to recover, and then this week the pound reached $1.42 for the first time in over 3 years. It then fell back a little bit, which is to be expected. You can see it's never just a simple straight line up, but it's a very positive thing that the pound starts to recover. While some people might say, well, that's a negative thing because the cost of our exports go up, it also means the cost of our imports are cheaper, which can be good from the economy. So it's a balancing act again for the government to get the pound at a right sort of level, but certainly to see the pound rising is a very positive thing. There was some negative news in the lead up to the Brexit the Brexit deal being announced towards the end of 2020, where some so-called experts in the world said the pound was going to go parity against the dollar, so $1 would equal £1, which would have been unthinkable really. Getting it down to $1.17, I think it was in February, March last year, was the lowest it had been in a hell of a long time. So to see it recover now to $1.42 is certainly positive news. Thanks again for listening to another update from Wealth of Advice. Just a nice little gentle reminder to say that we're having our annual webinar on Friday the 5th of March. Obviously in previous years we've had that at the Ramside in Durham. This time we're having to do it online. We've had a good number of clients respond to our invitations to log in and watch the webinar next Friday. Anyone who hasn't yet signed up, there will be a link on this email. Please get involved if you want to hear us next Friday. We've got some very interesting fund managers on there. We've also interviewed a local MP who's the MP for pensions. There's other staff members from Wealth of Advice will be speaking, so we hope it's going to be a very valuable 90 minutes of your time if you can log on and do that. So thanks again for listening, and as we always say, if you need anything else from us at any time, please don't hesitate to get in touch.